Don Strazheim, the Senior Managing Director of International Strategy and Investments. He joins us this morning from Los Angeles. And Don, I know you make the point here saying do not mistake this for a revaluation. Beijing still firmly in control of its currency.
Well, that's exactly right, Margaret. What they did is basically break the explicit peg and then the crawling peg against the dollar, which has been in existence since 1994. But this is not a move to a market-determined exchange rate. The currency value is going to remain made in Beijing, not made in the markets. It wasn't a revaluation. It wasn't even a promise to a gradual appreciation of the currency versus the dollar.
Well, it's certainly being read into a great deal all around the world. If you take a look at the global equity markets, they're very much rallying on the hope that any kind of appreciation will mean increased demand for all sorts of commodities and the like. I mean, tell me what this does to China's toolbox here. If they're not tapping the brakes on growth, what are they doing here? They're just adding more control?
Well, they're not really tapping the brakes on the economy with this move, Margaret. What they're doing is basically saying we now in the future are going to consider the value of the euro, the yen, the UK pound, maybe the A dollar, the Canadian dollar, the Brazilian real, the Swiss franc, various currencies, not just the dollar. And that's, I think, a very good thing. I don't want to criticize them on that score. Anything that gets them somewhere closer to a more globalized exchange rate regime is very much a positive. That's what the equity markets are saying.
Don, I want to ask you, will we see China purchase less treasuries as a result of this move? What's the downside to the overall U.S. economy?
No, this won't mean explicitly less purchases of treasuries. That will come about because and only because China's trade surplus diminishes and or its foreign direct investment inflows diminish. Those are the factors to watch. And I believe over the next few years you're going to see that happen, which is why the appreciation in the dollar, in the yuan versus the dollar, is going to be kept at a very slow pace by China.
All right, Don, quickly before we go, does this actually mean the Chinese consumer is going to go out and buy more things instead of saving their cash?
Well, maybe a little bit, Margaret, but the reason the savings rate in China is as high as it is because the Chinese consumers think they need to save a lot. That'll change over time, but a long time.
All right. Thank you for your perspective.